Welcome to The Explainer. Today we're taking something that usually sounds, well, intensely complicated, macroeconomic Federal Reserve policy, and mapping it directly onto your personal finances. Look, when the Fed makes a move, it sends this massive ripple effect through the entire economy. So in this session, we're going to translate those high-level, closed-door decisions directly into what actually happens right inside your wallet. Let's get right into it.
Okay, let's dive into our roadmap for today. We'll start with the federal funds rate, then move on to borrowing with mortgages and credit cards. After that, we'll look at saving via CDs and bank accounts, followed by investing in stocks and bonds, and we'll wrap it all up with the big picture.
Section 1. The federal funds rate. Let's understand the basics.
So, when you're reading the headlines and they're screaming that the Fed is lowering rates, what they're actually doing is manipulating the federal funds target rate. You can kind of think of this as the wholesale cost of money. It's basically just the guideline for the actual rate that banks charge each other on overnight reserve loans. That's really it. It's just a bank-to-bank overnight lending rate. But, and this is absolutely crucial, it is the highly specific, incredibly powerful lever they pull to influence the money supply of the entire country.
Now, why exactly do they pull this lever? Well, the Federal Reserve operates on a dual mandate: price stability and sustainable economic growth. And their magic number, their target inflation rate, is exactly 2%. Honestly, it helps to think of these rate adjustments exactly like a thermostat in your house. If the economy is running a bit cold and they really need to stimulate growth, they turn the dial down and lower the rate. But if things are running way too hot and inflation is spiking well above that 2% mark, they raise rates to cool the whole thing down.
And this brilliantly illustrates how that abstract, high-level Fed rate actually trickles down to you and me in 3 distinct steps. Step 1, the Fed cuts the target rate. Step 2, banks lower their prime lending rate. Now that's just the baseline rate they charge their absolute best, most creditworthy corporate customers. And then, Step 3, consumer variable borrowing costs drop. Because you pay prime plus a premium based on your credit score, when that bank-to-bank rate drops, the prime drops, and your costs drop right along with it.
Moving on to Section 2, borrowing, covering mortgages and credit cards.
Now, the specific details of your mortgage completely dictate how you're going to experience a rate cut. If you've got a fixed-rate mortgage, your monthly payments remain completely unaffected by a Fed rate cut. You're locked in, so you won't see a change. But on the flip side, if you have an adjustable-rate mortgage, an ARM, or maybe a home equity line of credit that's linked to short-term yields like SOFR or the prime rate, you are an absolute winner when rates drop. Your payments will generally decrease as they reset to those new, lower short-term yields.
We see a really similar dynamic with everyday debt too. For fixed-rate credit cards, a Fed cut usually brings absolutely no change to your interest charges. Though, quick side note, credit card companies can technically always adjust those rates if they give you advance notice. But for variable-rate credit cards, those are directly linked to the prime rate. So if you're carrying a balance on a variable-rate card, a rate cut is likely going to give you some immediate financial relief by lowering your interest charges. Just, assuming you don't immediately go out and celebrate by maxing out the card.
Okay, Section 3, saving. We're talking CDs, bank accounts, and your diligently tucked away money.
Now, what's really interesting here is how different savings vehicles react in completely distinct ways to a rate cut. If you hold an existing bank CD, zero impact. Your higher rate is safely locked in. But for new CDs and your standard savings accounts, those yields are going to drop, usually within just a few weeks of the Fed's announcement. Taxable money market funds will also adjust lower, moving right in line with the Fed. But interestingly, tax-free municipal money market funds might not follow the Fed strictly, simply because their rates are already lower due to their tax-exempt status. It literally pays to know exactly where your cash is parked.
Section 4, investing, focusing on stocks and bonds.
So, lower rates generally act as a massive catalyst for equities. Stock prices often get a nice boost because corporate borrowing gets cheaper, meaning companies can invest and hire for less money. Plus, margin account investors suddenly gain increased purchasing power because they're using cheaper leverage. And when looking at bonds, longer-term bonds are generally way more sensitive to these rate changes than near-term ones. Just keep in mind that when rates are slashed, those existing higher-yielding bonds you might already hold suddenly become much more valuable.
Finally, Section 5, the big picture and our macroeconomic reality.
Let's ground all this theory in some real, hard data. Back in September 2025, the Federal Open Market Committee officially lowered the federal funds rate by a quarter point, bringing it down to a range of 4 to 4.25%. This wasn't just numbers on a screen. This was a real-world trigger event that set off the exact ripple effects throughout the entire banking system that we've just been mapping out today.
So, the crucial point is summarizing this ultimate dynamic: who wins and who loses.
Well, borrowers generally benefit from rate cuts because loans just become cheaper. And a fascinating side note here, borrowers also actually benefit from inflation, provided their wages rise, of course, because they end up paying back old debt with money that's technically worth less. Conversely, banks and savers are the ones cheering for higher interest rates because those generate larger loan revenues for the banks and much juicier deposit yields for the savers.
Which brings us to a really critical question to end our explainer on. Are you positioned to be a borrower or a saver in the next rate cycle? As we've seen, your personal financial posture entirely dictates whether you cheer or groan at a Fed announcement. I highly urge you to go check the terms of your own financing, your credit cards, and your savings agreements today. Know what you hold so you can prepare your wallet for exactly what the Fed decides to do next.